Episode 3 of our podcast series is titled Markets Without Noise, which we think is quite apt with everything happening in the world right now, with the conflict in the Middle East, what's still happening with the war in Ukraine, and eventually, even when these things do end, and hopefully they do end soon, there'll always be something happening. There'll always be something to worry about. Something new will come along. So what we want to talk today is about, how do we navigate investing? How do we navigate markets in a volatile and uncertain world? And in our previous podcast, we spoke about retirement, not as a financial event, but as a transition of identity. But before we talk about today's topic around markets and noise, it's worth acknowledging something small but symbolic. So when we launched the series in episode 1, we titled our podcast called The Long View.
I still think that's a great name. But
it is a great name, and it encapsulates exactly that. The long view, investing, thinking long term, super apt. But because unfortunately a very prominent brand had taken that podcast name, we've pivoted slightly, which also speaks to the need to keep, remain flexible, adapt when you need to. And a lot of our philosophy at Henceforward is talking about giving wealth purpose. So with that, we've rebranded and called our podcast Giving Wealth Purpose. And today we want to speak to that in the context, of, how do you navigate life through uncertainty, through volatility, when things feel scary, when things feel uncertain, what do we do? How do we handle that? So markets with noise is what we want to talk about today, and hopefully we'll give you some food for thought into how we can handle difficult periods and what some good things are to adopt and things to potentially avoid and mistakes to avoid, so that we don't make poor decisions and end up in less ideal outcomes.
I mean, quite interesting, Carl-Peter. And before we go into there, I see what you did there. The name change, pivoting because things are uncertain and the need to adapt. Well played. But yeah, if we look back in history, we've been here before, right? It's just another name. It's another bit of uncertainty. We look at those charts going back last 100 years and, you look at the volatility. We had the Great Depression, we had the .com, we had GCF, Trump, COVID, Ukraine, you name it. We've kind of been here before. So things like this are not new to us. And I guess what we're really trying to answer is like what actually matters and what is just noise.
So, yeah, with that, understanding kind of how things work, why emotions are triggered. We know we live in an era and an environment where headlines and media are designed to trigger and get reactions out of us. So, when you open whether it's traditional media, your social media feeds, and typically the headlines, the messaging is designed to make us feel something powerfully, whether it's positive or negative. And often a lot of the headlines that we experience when it comes to investing in markets, more often than not, come across as negative, particularly obviously in times like we're going through at the moment. And there's also something quite interesting when it comes to investing in markets in particular, is that people who give the negative argument, that talk up the bad news, that talk about the risks, for some reason sound a lot more intelligent than people that talk about, the positives and the upside and all the good things happening. And that also, I think, speaks to our psychological profiles as investors, where we typically feel the loss or the loss of investing twice more powerfully than we do, the benefits of a gain. So when we see those kinds of negative headlines, it elicits something quite powerful in us. Versus when things are, good and normal, then people tend to, pay less attention to that. So, I mean, what are the kinds of things that, through experiences dealing with clients, dealing with market volatility, the kinds of things that we see come up, I guess, number one, a lot. And then the behaviors and the kinds of things that we can do for our clients to help them navigate those stressful, uncertain, anxiety-producing moments.
I mean, before I get to that, and just to add on to what you said, about the media, I think we're like in a time where it seems to be louder than noise. And, if you think of a business model of normal news agents, that's their business model. Like, they make money by selling newspapers, getting clicks. And so we know fear sells better than, than good news. Even in a newspaper, the fear stuff is in the front, and the sports section, which is based on achievements, is at the back of the page. Things, social media, TikTok, Instagram, Facebook. It's become so easy to like and share the nonsense that comes out there. It's become easier than it was 10, 20 years ago. WhatsApps to forward bad news. And like you say, we look at this bad news, and quite often we anchor that to making sense and some of our other thoughts and that we have, and it goes to serve those thoughts, and well, it must be true because I've seen it. But we also know in social media these days that there's a lot of fake news. I mean, it still baffles me to understand what they have to gain from creating fake news. Is it clickbait, or I don't know. I don't understand these things. So, I mean, you spoke about things like loss aversion and the financial media, but we have these conversations with our clients around those other emotional drivers, around greed and fear. As markets move up, people become greedy and tend to want to get in on that action. And, we know markets move in cycles. And, as we start going in that downward trend, there's a whole lot of emotions that are kind of driven by fear at that trough. And we know that a lot of investors do the actual opposite of what you should be doing. To make money, whether it's a business, whether it's investing in stocks or shares, the idea is to buy low and to sell high. But we often see the opposite, people making decisions at those wrong times, buying high and selling low.
Exactly that. Because we get so focused on the short term, and, our time horizon and the way we think about things becomes, days and months, instead of going back to, what was this original strategy, where we're typically thinking in terms of a multi-decade time horizon, 10, 20, 30 years potentially. So, is what is happening today, whether that's war or conflict or some other financial crisis, is that going to have an impact on my, 20, 30-year plan, whatever that is, to achieve financial independence, maintain financial independence? And more often, the answer to that is going to be no. And if you zoom out over long enough time horizons, and to your point, you look at all that volatility that happened along the way, whether it was the great financial crisis, where markets fell 50%, whether it was the dot-com bubble, where markets, also fell a huge amount. Eventually things change, the narrative changes, all that negativity shifts, and good things start to happen again. And that doesn't mean one doesn't need to be flexible with one's investment strategy. Sometimes you do have to pivot, you do have to make some changes at the margin. But getting out of the markets, for example, to your point, at the optimal time, by selling low and buying high, inevitably lead to poor outcomes. because timing that transition, getting in and out again, is actually very difficult. And sometimes the best thing to do, and Warren Buffett likes to say this, when things are uncertain or there's no obvious answer, the best thing to do is simply nothing, is to wait and see. So, sometimes we feel like we have to do something because things are happening, and, but often because we don't know what the future holds, how things are going to unfold. Sometimes you've just got to wait, let things ride out, wait for the dust to settle. So it's we appreciate it is difficult and it's tricky. And, when you see the value of your investment suddenly fallen by, whatever amount of percentage, that's deeply uncomfortable. And I guess part of our value add as advisors is to remind clients, don't get in your own way. Don't make poor decisions. And
so are you saying, part of our role is around education? It's, I alluded to in the beginning that this is nothing new. We've been in these situations before, and we're going to be in them again. There's always some crisis. Can you remember the crisis in 2017? No, it doesn't really make a difference anymore. It doesn't matter. But yeah, it's kind of driven by a lot of those emotions. And I guess our role is to hold clients' hands through that and to try kind of, signal through, when we have to do something and what's just noise. Because most of the time, it's just noise. If you look at, what's going on now in the Middle East, every single day we're inundated, even in our own profession and industry, with brokers' notes, things coming out, and we feel this need that we have to do something. Sitting on the sidelines kind of seems difficult. There's another argument, when markets are cheaper, should we not be buying more? Comfortable to buy a month ago when markets were higher, but now markets are trading at a discount. It just feels sometimes counterintuitive to want to go and buy into those markets. I certainly know when I go to Pick and Pay and I see washing powders 3 for the price of 2, that's on a sale. I go and I buy that washing powder. But somehow when it's our investments, we kind of we feel that we can't do these things.
And on that, there's people also confuse volatility with risk. So when we talk to clients, we often explain to them that there are different kinds of investment risk. The main one that investors and our clients tend to think about is that volatility risk. Markets are moving up and down, and that feels deeply comfortable, because when markets have fallen 20%, you start freaking out. But there's a difference between volatility risk and the permanent loss of capital. Now, in a well-diversified portfolio, that risk of permanent loss of capital, given enough time, and if you've structured your portfolio well, is minimal. Because markets typically recover, and your investments will recover their value and grow given time again. The permanent loss of capital, the big one, is typically driven through poor behavior. That permanent loss of capital that most investors then suffer is because they then end up making poor decisions, selling out of investments at the inopportune time, locking in losses, and then not being back in the markets when things begin to recover. And then you have another third potential risk. And as a result of that, you don't have enough money when you actually need it. So it's that capital adequacy risk, not having enough money, for example, at retirement because you made poor decisions. You didn't stay invested through full market cycles. And it's often interesting, stats that we show our clients around, the research that banks like JP Morgan and others have done, the return that you as an investor receive relative to the fund that you actually invested in. And often there's a big gap or mismatch between the return that most investors receive and the funds that they're investing in. In other words, they're getting less of a return than the funds that they're in. Why? because they're panicking and selling out at inopportune times. And that's why investor behavior is such an important thing. And often the most successful, and again, everybody likes to quote Warren Buffett, but it's being boring. It's being disciplined. It's having that strategy. It's having plan and understanding that, successful investments take not only years to play out, but decades to play out. So it's having that patience, it's having that fortitude, it's understanding your plan. And yes, sometimes at the margins, things need to be tweaked and rearranged because things do evolve, strategies evolve, sectors evolve. What works today isn't necessarily going to work tomorrow. So you want to remain forward thinking, but it's still having that fundamental plan and strategy to guide you. And trusting in that to get you ultimately where you want to be.
I mean, again, we acknowledge that and appreciate that it is sometimes difficult, sitting on the sidelines and, not doing anything. But, bad investments aside, we do know, historically that, growth investments in volatile times take the biggest hit, but we also know that they take the sharpest recovery. And so one of the worst things to do is to move out of a strategy, where you're sort of targeting towards growth, locking in that loss, moving into a conservative approach and missing on that upside. There's a lot of data out there from, a lot of the asset managers and international banks where they talk about over a period of 15, 20 years, the different variations of that, staying invested versus being out of the market for one day, the best day, being out of the market for the best 10 days and 20 days, etc. And the contrast between, what investors earn, like you were saying earlier, and what they would have if they stayed in the market are quite scaring. So again, it anchors around, we'll talk about this a little bit later, but it anchors around your plan. And sometimes, not making changes unless your plan warrants it. And I'm not talking about like you talk about on the margin calls, those little things. But urgency is often the enemy of discipline.
Exactly that. And, if we step out and step back and look at it from a high level, what do headlines actually change about your 20-year wealth trajectory or plan? If you really think about it.
Yeah, nothing. Carl-Peter, long-term wealth is built by what we call boring variables. It's not about being in sexy investments and the latest buzzword of an investment, but the data shows us that it's not necessarily being wealth comes from being invested in fund A or fund B or share A or share B, but more should you've been in shares at the right time. So in other words, asset allocation is probably the single biggest determinant of outcomes. And the things like that become important when we're trying to waft through what is noise and what are the signals. What sort of other things do you think are kind of headwinds to achieving outcomes in a sound investment plan?
Yeah, so I think some of the biggest headwinds are, number one, not having a sound investment plan. That's the obvious one. Number two is, we understand one of the most powerful determinants of long-term success is being in a well-diversified portfolio. And what we increasingly seeing, and without many people realizing, is that their portfolios are becoming more and more concentrated because people also assume that, what worked, before is going to work tomorrow. And we know the world is shifting and changing, etc. So, the best investments for the last 10, 15 years are not necessarily going to be the best investments looking at the next 10 or 15 years. So for example, we know index investing and passive investing has become super popular. And we all for index in investing and passive investing because, fees matter and fees are a massive headwind on compounding long-term returns. We know that. But many of the big index funds and ETFs that people have invested in and anchored themselves to over the last sort of decade or so have become very concentrated in a handful of big names. And things are potentially starting to shift. So assuming, that strategy is going to work looking forward, we would argue is dangerous. So how you think about diversifying a portfolio now is becoming increasingly important, not just from a pure asset allocation perspective, but what regions and places in the world that you're investing in. For a long time, it was just, you could be overweight the US and assume that's all going to work out well. Things they are starting to shift. So that diversification across regions, across currencies, for example, as South Africans, we already tend to have most of our wealth and balance sheet, tied to the South African economy in one form or another, whether it's our pension funds, our houses, all those kinds of things. So, and a lot of our discretionary investments as well. So in terms of meaningful diversification, are we getting sufficient global exposure to be properly diversified? Because it's not about thinking about what's happening now. It's about thinking, okay, well, where's the world potentially going to be in 5, 10, 15 years time? And how do we position for that? So, those principles around diversification and asset allocation, to your point, are super important. And it's more just than how much do you have in equities, how much do you have in bonds, but it's going into the nuance and the detail of that and how to, we spoke about changing things at the margin. Those are things that are, constantly shifting, those kinds of allocations and where you're allocating capital. And those are, things that we think about a lot and that we want to kind of bring to clients to try and, optimize portfolios, because you can never, everybody's always looking for the best, best portfolio, best performance, ideally at the lowest possible risk. And, that panacea, unfortunately, just doesn't exist. So it's being really thoughtful, understanding the trade-offs, thinking about diversification, how to build a balanced portfolio a lot more deeply and carefully, with some of those important concepts in mind around, your cost considerations, et cetera, et cetera. So, those are a few of the things that I think come to mind for me when we think about that.
Yeah, I mean, I think those are good drivers and those are compounders. I had a chuckle when you were talking about the cost and the growth. If we ask any client, what's your ideal investment, it'll be maximum growth, lowest cost, and no risk.
Yeah, exactly.
But, that's pretty much like the Easter Bunny and Father Christmas. I hope my children aren't watching this. No, they don't really believe in those. So, yeah, I mean, things that an underestimated or undervalued thing is really about that plan. It's kind of understanding like what your investment actually needs to do. So we spend a lot of time with our clients, Carl-Peter, trying to unpack that lifestyle that they're trying to lead, trying to understand, to give them the return on life. So it's about understanding what it is that they need, when they need it, how does that look, and then we kind of translate that into the financial things. And we spoke about the cash flow modeling and the assumptions that we use in there, and really the outcome of that is to kind of understand that mathematically what is that return that they need to achieve their goals. And because once we understand that actual number, whether it's an inflation plus target or whatever it is, that helps us have a conversation around the asset allocation that's needed to get there. And to your point, some of that nuance becomes in, once we understand what that asset allocation is that you need, it's understand what's going on in the world, like from a macroeconomic point of view. What are the tailwinds, the headwinds, whether that be, from a geographical point of view that you mentioned. But that's where we start, we talk about at the margins. That's where you kind of start crafting around there. You touched on cost control. In our language, we talk about investment returns matter, because the investment return that you receive will translate into the outcome, the lifestyle that you're trying to, live. And what's that? That's a function of what the markets do. So you could be quite clear that, the investment is designed to give you that type of return that you need. So if you need a high growth return, you need to be in assets that are likely to give you that high growth. And equally so, if you don't need such high growth, that you can take some risk off the table. But it's also a function of costs. Now, costs are inevitable, but we're very meaningful and very intentional in trying to design portfolios that are kind of cost effective. We're not afraid of spending, in terms of costs, but they have to justify what they're doing. So whether that's making use of passive to bring portfolios cheaper or to take risk off the table, one has to put a lot of consideration in that rather than just choosing some off-the-shelf, popular brand name type of strategies. Other things that I think, kind of erode wealth or, or the kind of the signals that we need to be focusing on is around tax efficiency, in structures, whether you're investing in your personal capacity, whether they're trusts, whether they're endowments, whether they're offshore trusts. We're seeing a lot of that now, and that makes a huge difference, compounded over time. And I'll talk about time now. So those are things that are really important. We've spoken about behavior, that driven by greed and fear, and those are things that really detract from outcomes. But one of the most ultimate multipliers is time. We throw these terms around like it's time in the markets rather than timing in the market, and they become cliches. Warren Buffett, amassed, was it more than 90% of his wealth?
More than 95%.
95% of his wealth, from the age of
65. Yeah.
And that's a really undervalued or underappreciated factor of a signal that really creates wealth, is that slow compound.
Yeah, exactly that. We get so focused on, what's happening in the short term with headlines and interest rates and geopolitics and, all those kinds of factors, often driven by the media, etc. But, actually when you take a step back, and what really matters is understanding that for money to grow meaningfully, you've got to let it be able to compound. And that means, number one, being in investments that can have the ability to compound. So by implication, investments like equities, that can do that. But we also like to share the story of the journey of compounding to really play out, literally takes decades. We think in months and years, but that compounding story, is a decades long one. And whether we think of it as, working towards retirement, you might have, whatever your age, 20, 30 years to go until retirement, but your compounding journey doesn't stop at retirement. You're still potentially investing for another 20, 30, 40 years post-retirement. So that compounding journey needs to continue. And that's why we talk about and why it's so important, again, we focused on the short term, the noise, markets, is my investment outperforming? But we're very much an outcomes-driven business. And the way we construct portfolios for clients is also outcomes-driven. So it's really about, to your point, understanding, what kind of return do you need to help you achieve your goals? Whether that's financial independence, making sure your money, lasts through retirements, whatever goal that is. It's understanding that. And that's simply, you always like to say, a simple mathematical calculation. This is the return you need. Once we, understand that's the return, that's the outcome. Well, how do we then build a portfolio to support that? Because it's very easy to get caught up on the short, what's outperforming, what's underperforming, etc. But once we understand that, then one can, take a step back and look at, okay, well, how does one actually build and craft that portfolio in terms of, the portfolio allocations towards which funds, which assets, active versus passive, all of that. Those conversations only come at the end. Being an outcomes-driven business is first focused on, okay, well, what lifestyle do you aspire to live? What are your goals? Once we understand that, then we can calculate the return you need to achieve that. And only then do we start thinking about, okay, how do we build a portfolio that gives you the greatest probability of success, achieving that over the long term? That's really what we're trying to solve for. And then the rest in terms of markets and geopolitics and interest rates, and that things perform so well and that's done so badly, that all just becomes noise. And it's then just taking a step back and reminding ourselves, reminding our clients, what actually matters. And are you on track to achieving your goals, to achieving what's important to you? And if we can tick that box, that's the most important thing to actually be.
I think about being able to tick that box removes a lot of the anxiety. And I kind of think back around like COVID time, like we had a big sell-off in markets. There was a lot going on. We didn't know how long this global pandemic would last. It was quite, in the heart of it, in the eye of the storm, it was quite scary. We went back to our clients and we just remodeled. We had a look at given the 20-30% that haircut that they had taken on their portfolios, how did their plan stack up to the asset base that they still had, right? And it was great to be able to show most of our clients that they were still okay. I think one or two, we talk about these trade-off conversations that if your plan doesn't look great, there are a few things that you can do. You can work longer and save more. You could spend less in retirement or spend less now and be able to reinvest that money. You could take more risk on your investments. And in that time, it was just great to be able to show clients that they were okay. I think we had one or two clients that were maybe a little bit, undershooting and, doing those trade-off conversations about what's possible now, because life throws like these unexpected curveballs to us and it's how we react to them. Not one of them changed their strategy. And, thankfully, markets improved quite drastically and we moved out of that. So these sort of short-term noises like things like elections, like in the long run, and you spoke about decades, and that's quite an important thing. Every single portfolio over decades has survived election outcomes.
Sure.
And so those are things on noise. They're not signals. Being able to not when markets are down, not move into something like cash, more conservative. Those are the sort of things that the behavioral things that we can kind of help clients. We can show them and alleviate the kind of stress around that. So, I think what's really important is coming back to that plan. Those are the things. Having a plan. Understanding those other signals. Those are the important things that are timeless. All these other little things are noise. With what the oil price is today, $120. Spiked at $120. That's not necessarily going to be sustainable over time. That's short. That's outlived. But funding for your child's education, that's something that's part of the plan, and we need to make sure that we are always outcomes driven and we can adapt to those things. So, we always say like only change strategy when your circumstances change and not necessarily, just that market noise.
Exactly. And I think a good question to end the segment with is, how often do short-term events permanently alter long-term wealth? Think about that. Okay. We've kind of been speaking about this and touching on this in various ways as we've been talking through markets and all the rest of it. But that kind of behavioral insurance impact and the impact potentially, then the role that it plays potentially in wealth destruction. Often wealth destruction, it's not market driven, it's behavioral driven. It's through the poor decisions that we ultimately make, like we were saying before, buying high, selling low, or during times of stress and panic, which is, suboptimal. And, some of the ways very intelligent people lose money, like we said, it's panic selling. You're crystallizing losses when markets are falling by selling out, moving to cash or switching into something less optimal. Another one, and you were talking about that before, is that greed. It's that performance chasing. Markets are going up. You've got the latest hot investment theme. You want a piece of that action, so you don't pay attention to some of the fundamentals in terms of valuations, having that discipline. So you're chasing that next hot theme. Eventually, the rug gets pulled, and suddenly that crystallizes into a massive loss potentially. So that's a potential risky one. Being overly concentrated. We're seeing that happen more and more, sometimes not by design, just people are, without even realizing, becoming overly concentrated in their portfolios, whether it's through things like, again, we've got nothing against cryptocurrencies per se, but as those have become more popular, more and more people's wealth have become concentrated in things like, Bitcoin and other kind of crypto assets. Like we said, becoming overly concentrated in index funds and ETFs that are being driven by the performance of a handful of similar companies. And probably another one that's also underestimated and something that we see is quite often, people who a big portion of their wealth is tied to the incentives and shares of their company's performance plans, through stock executive options. So you've got single stock concentration tied to your business or your employer, which potentially has significant risks. So, how do we mitigate some of those behavioral impacts and start helping people make, better decisions? I mean, what are your thoughts around that, around, the planning side and
Yeah, I mean, when you were talking about that concentration risk, I was just thinking, we've had a couple of clients who, work for these global consulting companies. And, we kind of signaled to them that you might be overly concentrated. And more often than not, they will answer with, I know this company, it's got legs, it's got, and it's like you're one person in a huge organization. And, and we found with the recent Trump's austerity measures, canceling contracts with these big consulting firms and share prices tumbling, that's one little thing that is affected outside of that great organization, may well be a great organization. And so, it comes back to that thing around diversification that we were speaking about. Other things, Carl-Peter, like we do see is that that emotional bias as well, clients tending to be conservative when they've had a loss or aggressive after a win, and it's kind of like balancing. We often talk about, when we talk about risk, and you alluded to earlier, most people think around the volatility risk, but there are all sorts of other risks, the risk of not being able to achieve your goals, not having money when you need it, that kind of liquidity risk, especially around retirees. And in that, there's that balance between that risk that you need to take, the risk that you're prepared to take and that you should be taking. And so it's kind of, again, while we're talking, everything kind of centralizes back to having a plan. It's like, if we know where we're going, then we'll be able to figure that out. And I kind of want to share like a story or an anecdote that I've used quite a lot. It's like, it's April, beginning of April. You've come down to Cape Town and you're going to meet some friends in Hout Bay, and so you leave a little bit earlier because you not quite sure how to get there. So you put the address in the GPS, and you start driving, and it takes you through to Claremont. But what you don't realize, it's the morning of the Two Oceans Marathon, and the roads are closed. And so when you get there, GPS doesn't judge you; it just says recalculating, and it takes you in a different route. And at that time, you're faced with some decisions. Do I still want to meet those friends for breakfast? In other words, are these goals of mine still important? If so, I can just drive a little bit faster, or I can phone them and just tell them I'm going to be late. Or because you left earlier, you're actually still going to be there on time. So again, it's about having that sort of plan, and kind of sticking to that plan and changing your strategy only when your plans change.
Mm. And it's about kind of also understanding ourselves and our own emotional drivers. Because I love this. It says, fear compresses time horizons. A 20-year investor starts thinking days, and decisions made in fear almost always look stupid 6 months later. And it's also understanding how we tend to react under times of stress. So when things are going badly, what kind of decisions are we likely to make? Do we become more conservative, for example? Do we see the opportunity and want to get aggressive? And the other side of that, I guess, argument is as well, when things are going really well, and you've, let's say, made money on an investment, investment returns are looking good, do you then become overly aggressive? Instead of going, okay, hang on, maybe I should take some chips off the table here. Maybe it's a good time to rebalance. That's a whole nother conversation, by the way, is about people's fear of rebalancing, particularly around the whole capital gains tax thing and not wanting to take profits because they hate paying tax. But we'll save that for a separate podcast. So the value of, I guess, an advisor or giving advice, it's helping you keep you in your seat and to your plan when everything, your instincts, your gut is telling you to run, or you have to do something, or you have to change something, when often it's just taking a step back, taking a breath. And sometimes the best course of action is simply to do nothing. And, we've said this and we'll say it again, investment success has got nothing to do with intelligence or IQ. And that applies as much to the everyday investor as it applies to, the big professionals, the really smart people running portfolios. And often the trait that separates the really successful investors over a long period of time is what? It's humility. It's understanding the things you can control, knowing the things you can't control, and having the wisdom to know the difference.
No, absolutely. So I guess, Carl-Peter, the biggest risk to successful financial planning is not the market, it's how we react and the decisions we make to things in the market. Okay, so Carl-Peter, when we've spoken about not doing things, not listening to the noise, and we've mentioned a few times at the margin, we need to make some tweaks. But, sometimes there is a time when we have to act. I think stewardship is around disciplined responsiveness and not just, changing for the, reacting for the sake of reacting. So when are those times where we should actually be making changes to portfolios or strategies?
Yeah, so exactly. That's a very valid point. Sometimes things do change that warrant taking action. So obviously a big one is when your circumstances change. Life happens. Things, whether it's divorce or illness or business, sale, inheritance, liquidity needs, whatever the case is. So, if something fundamentally has changed or shifted in your life, then absolutely, that's a time to review things and potentially take action.
What about like structural things, laws change or tax laws change or...
Yeah, exactly. Structural things, tax laws change, mandate to a fund might change. That star fund manager has now gone from that company to another company. So it's kind of being aware of those things as well. Your risk capacity has changed for whatever reason. And that's off, and coming back to our previous episode, that risk capacity and how you think about risk as you transition from building towards retirement, where you're still earning an income, and when you transition into retirement and you start drawing an income from your capital, often that requires subtle shifts in terms of how you think about, setting up a portfolio and managing a portfolio. We won't go into details today, but that how you think about risk and that risk capacity, and sometimes long-term assumptions do change because they impact asset prices. Whether that is, what are the implications for things like, long-term interest rates. We've become very used to, for example, looking at the 2010s to globally a low interest rate environment, which had an impact for certain assets, asset prices, etc. Now we're moving into an environment where globally interest rates are higher, which has implications for, different opportunities, investment sets and other assets and other asset classes. So when we think about that in terms of portfolio construction, like we say, sometimes there is a need to take action and you do want to be doing something, but that doesn't necessarily change the plan fundamentally. So, at the high or strategic level, we still have that outcomes-based plan, understanding where we want to get, understanding the kinds of returns that we need to get us there. But then, once you lift up the hood and you look at, what's inside your portfolio, for example, how we get there, things might need to shift or change, or something that isn't working because it worked before needs to be, swapped out for something else. And, I guess one of the big frustrations, we get a lot from new clients that join us is that they often get the message around, everything is fine, you never have to change anything, almost that what's that word? I don't want to say condescending, but just like, don't worry, it's all gonna, a little bit patronizing, and that lack of proactivity, I think we always have to be testing our assumptions. Again, it comes back to that humility factor, understanding that, things can change. And it's having, and when the facts, there's that quote about, when the facts change, then sometimes you got to change your mind. Because what we know today might not hold true tomorrow when it comes to the facts. So having that flexibility to understand in our thinking and be prepared to make changes at times, is important. It's not ripping up the playbook entirely, but it is understanding that, the world is evolving rapidly. So we can't, we don't want to get married to our assumptions to, what we think is true today is necessarily going to work tomorrow. So having that flexibility, I think, of thinking, and when it comes to our investments and getting them where, and the purpose they serve in helping us meet our goals over the long term, is super important.
There seems to be a central theme through all of this. It's around, that plan, really designing that plan. You kind of do all that thinking up front in terms of what the plan needs to do, the assumptions, what you need it to do for you. You've mentioned things that, your circumstances can change. So, that would warrant a portfolio change. When the assumptions that we use, when that changes, and quite often that does, some of the thinking that we've had long term is different because we're in a new world and the way some businesses are run. If you think of like in the tech industry, it's completely different to what life was 20 years ago. And so some of those assumptions might be changing. I guess one other thing important is having that liquidity buffer, so it's the market can change in the short term. Sure, no problem. But what kind of things do we put in place to make sure that we can ride out that noise? And quite often that's liquidity.
Exactly.
I think, so that's because once you've got that design, you've tested it, you've done the long-term thinking, you've created that liquidity buffer, then the sort of market noise actually just tests your design. It doesn't dictate it,
That's well put. No, exactly that. So it's understanding the difference between structural changes and cyclical noise. Most of the stuff that we see is cyclical noise, but sometimes structural changes do occur. Whether that's long-term structural changes around inflation rates, which is quite topical in South Africa now because we know the Reserve Bank was talking about wanting to structurally change our inflation, now down to 3%, what are the implications of that for, lifestyle, portfolio construction, all those kinds of things. And, understanding what's the difference between discomfort and genuine risk. So it's less about, what should I do more, or what should I change about, what's happening now in the world, whether it's war or conflict, or, whatever headline, happens to be in the news of the day. And it's really more about asking a question around, has anything really fundamentally changed in my life? And do we, as a result, then need to be changing the plan or the strategy?
Yeah, I agree with you. So it's, what's changed? Do we need to make changes, or we just kind of stay anchored to that plan that we've created? And I guess, like, Carl-Peter, when wealth has purpose, volatility loses its urgency. And just like, we started off and we spoke about us having to change the name of our podcast, because, the circumstances presented that. It's about just thinking about what good stewardship is, thinking about these things thoughtfully and not abandoning your principles. And I think if you can do that, you'll be able to have a plan that can withhold a lot of the noise that we hear every day.